Mohamed, always great to catch up with you, sir. We've seen this movie before. Restrictions, weaker data, we reopen, and we snap back really quickly. Is this going to be any different?
Well, we hope it will be different in the sense that we've got the vaccines at the end of this tunnel. So the light is shining a lot brighter. But ironically, the journey there has gotten darker, John.
One thing you've said, and said repeatedly earlier this year, to know where you're going, you better know where you're starting from. A lot of people are willing to de-emphasise where this economy is going in the near term, Mohamed, and emphasise where we'll end up, the destination, with a vaccine much better the back half of 21. Do you still think that's a mistake?
So I think it's a mistake because you can't apply it across all sectors. It's not a mistake if you're applying it to tech. It's not a mistake if you're applying it to other sectors with very strong balance sheets. But if you are investing in a company with a very weak balance sheet, yeah, that would be a mistake.
We were asking a question yesterday, I asked it repeatedly this morning as well, Mohamed, what it would take to get equities to go down. What do you think it would take to get this stock market to go down? Here we are at record highs. Fiscal talks haven't resolved. We think they might. Data's weaker going into 21. It's very difficult to paint a bearish story for stocks, Mohamed.
Yeah, and you've heard me say over and over again, respect the technicals. And the technicals are incredibly, and I stress incredibly supportive. So what would it take? It would take a U-turn on monetary policy. The probability of getting that is de minimis. 2, it would take a massive accident in some segment of the market because people are overstretched. Well, financial conditions are so loose that the probability of getting that is very low. 3, it would take a wave of bankruptcies. That's the most probable risk, but it is a risk, not a baseline. I understand people who are surfing this massive liquidity wave. I really do. It makes total sense from the short term, but the further you go into next year, the more you have to care about fundamentals.
On the policy front, Mohamed, do you think we're trapped here? That there is any exit for policymakers coming out of this?
So, it's really curious on the policy front, Jonathan, because where you want policy, you're not getting enough. And where you don't need policy, you're getting too much. That's a fundamental imbalance in the policy mix. And we will get some more fiscal policy, but let's be clear. It will be limited, it will be narrow, and it will not be sufficient. And the big question for me is not whether something is better than nothing. Yes, something is better than nothing on the fiscal side. But the bigger question for me was raised by Kevin. What does it mean for the next round? So ironically, we were hoping to get relief now and then pivot to a lot more than relief when the Biden administration comes in. It looks like we're doing a bit of relief now, and the first 100 days of the Biden administration will be occupied by relief to local and state governments, whereas we need a bigger pivot in policy.
Assuming that there will be another round, Mohamed, how critical do you think January 5th actually is?
It's really important, John. There's a lot of people who say a divided government is best, but when you need to take big policy decisions, you do need the ability to get things done. So either you would hope for some collaboration among the two sides that we haven't seen for 10 years, or you need one party to be in control.
Mohamed, most Fridays of this year, you and I have caught up, and the year has changed radically as the year has grown older. Let's just look back and reflect just for a moment, Mohamed, on the lessons of this year for you, your takeaways, if you will.
So my biggest takeaway, there are 3. One is, of course, for markets, that liquidity matters a great deal. And if you have someone with a printing press in the basement willing to use it, pay attention. 2 is the extent, the weakness of our safety nets. A lot of people have suffered this year, John, and they shouldn't have. And it just tells you that our safety nets are too weak. And 3rd, what we haven't focused enough on, John, are the silver linings of this crisis. You and I can take up your whole show talking about the silver linings, and that's important because we need to bottle these up and make sure they stay with us as we pivot to a more normal world sometime next year.
Let's apply some of that to markets as well, Mohamed. You've been very open and transparent about the fact that you weren't as constructive on risk assets as you perhaps should have been. And the outcome is evidence of that. We look at the outcome and we say, yes, that is true. But, Mohamed, when you look at the process that you go through to make these decisions, any reason to change that process after the year that we've just had?
So looking back, I wish I had paid more attention to technicals and less attention to fundamentals. I exited too early. But John, I always ask the question, and I'm really glad I'm not investing other people's money because I would hate to be doing it in this environment, but I always ask the question for myself. If I end up making a mistake, is it a mistake I can live with? And that's the question every investor has to ask. I can live with the mistake of saying, you know what, I was too pure on fundamentals. I cannot live with a mistake that says I ignored a process that has served me well and just went for the big liquidity surfing element. And I misunderstood those dynamics. So, you know, yeah, clearly looking back, I wish I had paid more attention to technicals, but ultimately every investor has to be comfortable with their process.
Yeah. Well, the reason I ask this, Mohamed, is whether we have gone through some kind of paradigm shift that means that your process adjusts somehow. And that I think, and there are many other people that write extensively about this, that we define whether our approach has been correct by the outcome and not the probability that the process was the right process to go through, that the approach was right regardless of the outcome, and to manage the probabilities. We talked about that with the work of Mrs. Duke earlier this week with Gershon Distenfeld of Alliance Bernstein. Mohamed, that's what I'm trying to get at here, whether something's changed this year or whether the lessons you learned this year will ultimately lead you down a troublesome path in the years to come.
Yeah, that's hard. Look, this is a multi-round process, right? So you've got to adjust dynamically. I think of it very simply, John, as the following. In your portfolio, you always want to have what I call a structural layer, things that make sense over time because you're exploiting structural mispricing. You also want to have a secular layer. You are positioning for long-term trends. But there's a third level, which is the technical side, the ability to be a lot more opportunistic. And what this year has taught me, certainly, is be more opportunistic and pay attention to that layer. It doesn't mean sacrificing the other two. And how you position those three depends on your risk tolerance and your ability to absorb the ups and downs of markets. But the big lessons for me is opportunistic stroke tactical is something that requires as much attention as the structural and secular layers.
We've enjoyed your contribution, Mohamed. A special thanks from me and the whole of the team for everything. And please thank the family for allowing us to have so much of your time through 2020 as well. Enjoy the holidays, Mohamed.
Thank you, John, and thank you for everything.